Hello and welcome to the Austin Community Foundation Mid-Year Market and Performance Update. We do these webinars twice a year, usually at the beginning of the year to review the previous calendar year, and then a mid-year update like the one we're talking about today. My name is Joe Skyman. I'm a senior consultant with Fiducient Advisors, and I work directly with the Austin Community Foundation and its investment committee on setting investment policy and selecting investment managers and overall managing the portfolio for the Austin Community Foundation, and in fact, meant all of the portfolios. So we'll move forward with a market update to start, and then we'll get into performance for the first 6 months of 2021 and looking back as well on each of the different investment pools offered by ACF. So if we look at our market themes so far in 2021, first and foremost, it's been a very strong year for investment markets. But there's been a couple of different themes. Obviously, if we look back at 2020, there was quite a bit of volatility over the course of the year. The things ended on a high note in terms of market performance in 2020, and I think you've seen that trend continue here in 2021. Largely, that's come from optimism from an economic reopening and continued vaccines here in the U.S. and overseas. But the pace of vaccination and therefore economic reopening has really accelerated more here in the U.S. Up until lately here, as we've seen in August. More so than we've seen overseas, and therefore you've seen a kind of a leading of the way of the United States in terms of investment market returns as well. As we look at this particular chart. I'm going to start in the middle of the chart and just talk about those gray bars, really focusing on the stocks here in the US and overseas. Again, some of the biggest beneficiaries of what we've seen, that US large cap index here in the middle of the page, up 15% so far for the year through June 30th. Just a really strong return for large cap US stocks. Again, those large companies, the biggest companies that you would expect in the S&P 500. So the Apples, the Amazons, the Netflixes of the world. And then you've got the small cap stocks just next to it, up 17.5%. So the ones, those smaller companies that are publicly traded that tend to be a little bit more sensitive to economic conditions, and with strong economic data, we've seen a nice rally from those small cap stocks, and frankly, that is again a continuation of the theme that we saw in 2020 as well. What's somewhat hidden in these numbers is that you do have a divide between the types of underlying investments. So you might recall that in 2020, growth stocks or growth companies that tend to really be focused in the tech sector and others that really focus on high growth in their businesses really did the best up until we had our first vaccine news in mid-November, in which case you saw a kind of a shift or a rotation from those growth stocks, which had really been leading the way for the last 5+ years, to what are known as value stocks. So you think of those more as financial stocks, cyclical stocks in the consumer space, things that tend to be more economically sensitive, really started to lead the way in the last 6 weeks of 2020, and really so far in the first 6 months of 2021. The ones that had been a little bit more beat up, more uncertain in terms of what the outcome was going to be from COVID-19 and what the economic sanctions and regulations that had been in place because of it were really affecting them. And you've seen that really start to adjust, and you've seen them really start to take some leadership in terms of returns here so far in this calendar year. Now, on the international side, if you look at the next set of bars here, developed international world, so think of that as Europe, Australia, Japan, up 8.8%. So still a very solid return for a 6-month period of time. But again, behind the US in terms of where its opportunity set is and where the returns have been so far this year, just because you haven't seen other countries vaccinate quite as big of a percentage of their population as we've seen here in the US in a short period of time. So again, more continued uncertainty. Investment markets love, I shouldn't say love certainty because they never get it, but they do hate uncertainty. And so that uncertainty is really continuing to overhang some of these other countries. And you see that even more so on the emerging market side. Again, a 7.5% return is nothing to scoff at in a 6-month period of time, but there are some elements of that. You've seen Chinese markets really pull back significantly compared to where they were even at the beginning of this year. And so you lose some of the kind of intricacies of the emerging market space when you look just at the index in terms of some of the winners and losers, so to speak, with even within countries and underlying companies. So again, very strong returns in a vacuum if you look at those numbers. A little bit behind again where the U.S. has been so far this year, but again, strong positive contributions from a lot of the stocks in the portfolio when you look globally. I mentioned, kind of the two other areas earlier on this chart. If you look on the far right-hand side, the light blue bars and the dark blue bars on the left-hand side, that story is really interconnected so far here in 2021. So on the left-hand side, you've got your bonds or your fixed income represented by a couple of different asset classes here. I'll focus on this U.S. core bond space because it tends to be the most widely talked about, but that's the investment grade, high quality bonds, corporate bonds, and treasuries that are traded. And for the quarter, there's been a really nice return. That's the bubble here represented that 1.8%. But so far year to date, still down about 1.5% here in 2021. And that's really been a tale of two different quarters. In the first quarter of 2021, we heard a lot about inflation and how we've seen inflationary pressures in the marketplace in the US and abroad. And those inflationary pressures typically lead to higher interest rates, as higher interest rates tend to be the medicine for inflationary pressures. And so what you saw in the first quarter was a significant movement. And when I say significant, it's on a relative basis, right? Of about a 3.5% movement just in the first 3 months of the year on that index. And you had a 10-year treasury bond at the beginning of the year trading at 0.75%, almost doubling in that 3-month period of time. So led to some negative returns in the bond market, yields being a bit higher. But you've seen those interest rates settle back down now in the second quarter, as we've seen the inflationary pressures, while they still continue to be in the headlines, you've seen them ease back a little bit. A lot of the pressures were coming from supply chain issues stemming from the pandemic, where you've started to have this economic reopening and significant demand from consumers here in the US that just can't get the materials or the goods that they're looking for because of the economic shutdown that continues overseas and the slower pace of reopening that I mentioned earlier. So those things are interconnected. The other piece of this story is, again, on the far right-hand side of this chart, is going to be those real assets. And again, we think of real assets as those things that you can see, touch, and feel. So think of real estate, think of commodities like gold, like agricultural products, energy, right? Gasoline, natural gas. So what typically happens in an inflationary environment is those assets tend to do very well. They tend to typically be a hedge for inflation. And so when you have rising interest rates like you have generally for 2021, because of inflationary fears or inflationary pressures, the things that tend to do well, and this is the whole concept of diversification, is to have things that are doing well in different environments when other things are not doing well. So when the bond market is, again, on a relative basis, relatively volatile, but not anything compared to equities or stocks, you do see that these assets on the right-hand side of the page tend to do well. So we've seen that really play out. So U.S. equity REITs, publicly traded real estate, up 22% for the year. And again, some of that coming off of a difficult year in 2020, where real estate, particularly on the commercial side, has been a little bit under fire about, folks working from home, continuing to work from home. For how long are they going to go back into offices? Or is office space going to be as valuable as it was before? So things like that are really driving, a little bit less uncertainty today is really driving that area of the market a bit higher. Commodities, again, I mentioned kind of natural resources. You think about gold and other commodities. Again, and energy being a big focus of that asset class. Performing very well. And then the S&P Real Assets Index here really, again, is kind of an amalgamation of different other different real assets, things like infrastructure assets, whether they are renewable energy, whether they are pipelines, those types of things kind of get put into that catch-all real assets bucket. Again, doing well in this inflationary type of environment that we see in the headlines. So that's the backdrop for what happened in the first 6 months of the year that has led to really strong returns. If you look at the right 2/3 of this page, and even on the left-hand side, you do have bars in positive territory for some bond asset classes, and even, like I mentioned, that core U.S. bond space is really starting to fight back towards closer to break even so far in 2021, which would be, again, a really good result, as we've seen again a big move in interest rates to the upside and then kind of settling back down here. I've mentioned inflation a number of times, even in my first few comments here, and we wanted to make sure that we provided a few additional pieces of information as it relates to inflation. Inflation overall, I think the takeaway here from this slide is that it's not bad, right? Inflation obviously can be felt, and I think we're all feeling it potentially at the pump when we're filling up our cars with gas, or we're at the grocery store and seeing the price of certain things and kind of looking at our grocery bill for the week or however long it may be is certainly a bit higher. And that's the kind of the real impact of inflation. But it doesn't necessarily spell doom and gloom for investment markets. And again, that's the kind of the focus of what we're talking about today, is that as investors, as long as we have strong economic growth coupled with that inflation, that tends to be a positive sign for markets. And it doesn't have to be this death knell for markets that once we have inflationary pressures, that the market is doomed to fail from there. And I think that's what this slide tries to get across in maybe a little bit more convoluted way than it needs to. But basically saying that as long as you have strong economic growth, that actually drives inflation, right? Inflation means that you have prices going up, and that's typically from a rise in demand. And if there's a good economic backdrop, you'll have good demand for those goods and services that will drive those prices up. So I think, in our opinion, as long as we continue to see economic growth, and we have seen that trend now for the last 4 or 5 quarters after the economic shutdown that we had due to COVID in early 2020, that can mean that this market continued to march higher, and that inflationary pressures are not going to be necessarily a bad thing for this economy. Our favorite chart, the quilt chart, as we call it, this case for diversification. As I mentioned, we talk about things needing to zig and zag at different times. And if you look at where we're at on a year-to-date basis, U.S. equity REITs, this is, again, the first 6 months of the year, up 22%. Commodities up 21%. Lo and behold, you look at 2020, one calendar year prior, rank ordering these asset classes. Look at the bottom 2 asset classes, U.S. equity REITs and commodities. So this is that kind of worst to first type of scenario where the things that are cheaper than others tend to do better, even in a short period of time. But valuation does matter. And so one thing we haven't mentioned today is that while stock markets have done very well, they are relatively overvalued compared to their history. And so that has to be acknowledged, when we're talking about stocks, or even when we're talking about bonds. And we'll get to that in some of our closing thoughts as well. But again, this chart really is our profession of humility that tells us we don't know what's going to be at the top in any given year. So we want to make sure that we own a little bit of all of this to try to take a more smooth ride. So if you look at that balanced right in the middle of the page, that orange really kind of falls in the middle. Most times, never at the top, but also never at the bottom. And that's really what we're trying to do, is smooth that ride as investors in various proportions, depending on our risk tolerance. And that's something that we spend a lot of time talking with the ACF investment committee about, is what is the right allocation for these assets, for these endowed funds, and for the funds that are quasi-endowed, that it might be in some of the midterm pools. It is a constant discussion for us as a committee and as a group to make sure that we're making those decisions on your behalf as fund holders, to make sure that we are doing the right things, and from a fiduciary perspective are really looking to maximize returns, to ultimately be able to make more grants to the community, which is the goal for all of these portfolios. So I'm going to jump right into performance now. So starting with the long-term active pool, the largest pool at ACF. So you can see those good returns that we talked about earlier when we look at that for just the second quarter, showing almost a 5.5% return on that long-term active pool, outpacing its benchmark for the quarter. And if you look at now on a year-to-date basis, the first 6 months of the year, double-digit returns. And again, coming off of a couple of really strong years in 2019 for markets, and then ultimately what ended up being a strong year for markets in 2020 as well. To have a double-digit return in a 6-month period of time here, again, is a really great result as we see it for, again, still a pretty well diversified pool of assets. And you look at the last 12 months now, and you think back to what that time period is. This is ending June 30th, so this is June 30th of 2020 to June 30th, 2021. So really, coming out of the depths of the, kind of the trough of the market, really in March of last year, have really gone straight up kind of since then. We've had a couple of fits and starts here, but really nothing even on a meaningful basis if we look at historical drawdowns or historical pullbacks. So up 33, almost 34% in the last 12 months, well ahead of the benchmark. So you see that from good rebalancing decisions by the investment committee at ACF, and also good investment manager selection. So you look at active managers that can add value in choppy markets, ones that are trying to beat the benchmark versus those that are just trying to achieve benchmark returns. You've seen some good added value above and beyond that benchmark. So kind of validating the process that this active pool, by having active managers and active asset classes, has really started to pay off here in the last 12 months. And that's really started to add value now over the trailing time periods as well. Over the last 3 years, annualized just shy of 12% net of all costs. And over the last 5 years in double digits as well. So again, strong returns really, the portfolio is really hitting on all cylinders, so to speak, from an allocation perspective, from a manager perspective, for the long-term active pool. And if you look at the allocation of what those assets are, for the long-term active pool, you can see broadly about what we'll call this an 80-20 mix. So 20 or 19% in this case in terms of target to global fixed income or bonds and cash. And then the rest of the assets we really focus on as kind of growth or return generating assets, tend to be a little bit on the riskier side. We talk about stocks or global equities here in the middle of the page, and then we get into the broad real assets, and then really the things that drive a good deal of long-term returns in this particular pool. If you look at the hedge funds and the private equity, those types of assets really are meant to provide really good risk-adjusted returns over the long term, even with some illiquidity associated with them in the pool as well. And so again, the investment committee at ACF has done a really nice job of understanding what are the liquidity needs for the endowed funds that are in this pool. What is the right mix of having some illiquid pieces that can drive those higher returns versus having enough liquidity for grants and things like that, and being able to keep up with public markets. So again, done a really nice job here. You can see we're a little bit underweight to that cash and fixed income piece or bond piece, and just slightly overweight to the alternatives and global equities piece of the equation here. I'd say the couple of things that did change here over the course of the last 6 months is adding what we call a dynamic bond piece. So really just meant to try to focus on, where we're in an environment with interest rates extremely low, trying to generate some return in that fixed income or that bond space above and beyond what the market is offering us today, by having a manager that is a bit more, as the name would suggest, dynamic or opportunistic, to be able to attempt to, again, generate those returns or generate yields above and beyond what we have in the marketplace today. So that has worked out so far. But again, a new addition to the portfolio. And again, conversations ongoing with the investment committee of the best way to build a portfolio. We don't want to bury our heads in the sand and kind of think that there's nothing else that's out there. So looking to make active decisions on allocation and underlying managers is paramount in every quarterly meeting that we have with the investment committee. Moving on to long-term passive, if we just look at trailing performance, you can see actually a little bit better performance so far in the second quarter and so far year to date in 2021, largely from the lack of those alternative investments. So the hedge funds and the private equity that we mentioned in in the long-term active, not present here in this pool. And that just meant they got more of the stuff that did really well in terms of stocks and real assets on the real estate side that are in this pool. So a little bit less of the assets that don't get marked, like the private equity that only gets marked up every quarter or so. So again, up 6% for the quarter, up just about 11% year to date. And again, really strong returns over the last 12 months, 32.5%, a little bit behind the long-term active, but again, right in line with where the benchmark is. And then over the last 3 years, again, annualized at 11.8%, a little bit behind that 12.5% benchmark. Recall that, again, the goal of a passive pool is to try to track with the benchmark as much as possible, net of expenses. So the benchmark is gross of any fees, and therefore the long-term pool that's shown net of all fees should naturally have some sort of trail over time, trailing that benchmark by about the amount of fees. And we're talking about 0.25% there on the long-term passive pool. So we should always expect to be a little bit behind that benchmark over kind of 3 and 5 year periods. But we see that gap is pretty well in line. In terms of where the allocation is for the long-term passive pool, again, really focused on kind of that 80-20 mix, as we call it. So basically right in line with that 20% on the global fixed income or bonds and cash total. And then again, on the stock side, you can see just slightly overweight. These portfolios, again, get rebalanced as cash flows come in from new donations and also from grants going out. That's kind of our natural rebalancing as well. So again, kind of right in line with where we'd expect the allocation to be based on earlier decisions by the investment committee to do some rebalancing earlier this year back in February. Moving on to the midterm pool, so midterm active. So again, this portfolio is a bit more bond heavy, a little bit less in stocks. You can see 5.58% for the quarter, so still a solid return from generally, again, strong stock returns, but also from better fixed income or bond returns here in the second quarter. But on a year-to-date basis, you can see the dispersion between this pool and the long-term pools. About I would say about a 2% dispersion, right? About 8.5% versus the 10+% that we saw in the long-term pools. But again, it's still a very good result relative to its benchmark. So we would have expected that this pool, again, about 7.8% on its benchmark year to date, meaning that, again, rebalancing decisions and good active managers have helped outpace that benchmark so far for the first 6 months of the year. And again, you can see over the last 12 months, that does, again, create that less exposure to stocks and more exposure to bonds, creates a pretty big dispersion relative to the long-term pools. We were talking 32-33% on those pools. Still, again, nothing to scoff at on almost 27% over the last 12 months and well ahead of its benchmark. But again, kind of shows you the differential between owning stocks and owning bonds in different proportions in the midterm pools versus the long-term pools. In terms of where the allocation is, so if you look here, again, I'll use our broad term 65-35, so 35 in bonds and cash, 65 in stocks. And we did make a change with the investment committee earlier this year, believe it or not, to add more to stocks. And that might feel a bit counterintuitive. So this used to be a 60-40 portfolio, and again, is now 65-35. But again, feels maybe a little bit counterintuitive when we talk about stocks being relatively richly valued and markets at all-time highs. Adding to stocks probably maybe doesn't feel like the right thing to be doing. But having robust discussions with the committee, we have to also acknowledge that bonds are, you can make a case, are maybe more expensive than stocks are relative to their history, just given how low interest rates are, and the outlook for the bond market is relatively bleak in terms of generating large returns, particularly in an inflationary environment that we're talking about. So we made a decision as a group to actively move towards 5% more to stocks and 5% less in bonds, to ultimately look at this portfolio to say, look, we want to be able to grow this portfolio over time. And that, adding more to stocks while they're still, again, richly valued today is our best bet to earn a positive real rate of return when we account for what our spending wants to be and where we have inflationary pressures today. So again, those decisions are being made at the investment committee level in tandem with us as advisors on the consulting side. And they've been robust discussions and things that we think are necessary for looking out over the long term and making those adjustments. In terms of pools, last but not least, the midterm passive. So if you look at the midterm passive pool, you can see again up north of 5% for the quarter and still over 8% year to date. And again, about 24.75% over the last 12 months. You can see this pool tracking a little bit closer to its benchmark compared to the active pool on the midterm side. There is no difference in allocation for these two midterm pools, passive versus active. The only difference here is, again, how we implement the underlying managers, with all passive options, as you might imagine, in the midterm passive pool, whereas the midterm active does have some passive exposure, but does have those active managers that are trying to beat the benchmark in a number of asset classes as well. And again, as I mentioned, these pools on the midterm side have the same allocation. So again, you see that 65-35, basically right in line with where our targets are as of the end of June here. And again, no changes on the horizon, as we've talked about with the investment committee for these pools moving forward as we sit here today in the middle of the year. That tends to be an end of the year / beginning of year type of dynamic when we look at updated capital market assumptions and how things have changed. So no change to the allocations as we sit here today for any of the pools, at least in the next 3 months before our next investment committee meeting. So that leaves us with some closing thoughts. And I think, as we sit here today, there's been a lot of good news, but we also want to make sure, as we typically do, that we are keeping our eye looking forward and not just looking in the rearview mirror. So these returns that we've seen so far here in the first 6 months of the year, 8% on the midterm pools, north of 10% on the long-term pools, again, have set the bar high. So I think seeing those returns really highlights how strong the economic recovery has been here in the first 6 months of this year, and frankly over the last 12 months as well. And we've seen those real assets really be the biggest beneficiary of that, largely due to, again, the inflation headlines that we've seen. But at the same time, we have to be mindful of what that means moving forward. I mentioned before, with expensive stock market valuations, that we can't expect to earn double-digit returns every year just in perpetuity. We're going to have to see some level of volatility, some sort of pullback to create an opportunity for those double-digit returns in the future. And I think the thing to think about is, as we think about, again, where valuations are, again, they are rich, but what are our alternatives? Our alternatives are things that are also relatively expensive in the bond market, and that as long-term investors, particularly for the long-term pools, even more so than the midterm pools, but you can make the same case here that stocks are kind of a necessary evil today. And I won't even call them evil because they've done very nicely. But as long-term investors, stocks give us the best chance to keep up with our spending policy, keep up with inflation over time, when we know, especially with bonds at just extremely low rates. And I'll give you a little bit of context here. We are trading on a multiple basis. So basically, how many times are people willing to pay for the revenues of a company? We're expensive, but still not nearly as expensive as we were back in 1999, leading up to the dot-com bubble. So again, expensive, but not as expensive as we've ever been. But again, the alternative now today, with the bond market where it's at, the 10-year treasury is about 1.3% as a proxy for bonds. In 1999, at least at that time, bonds could get you in the neighborhood of 5.5% to 6%. So you had an alternative to move from stocks to bonds in the late 90s, because bonds at least had higher yields. And as we sit here today, though, again, expensive, but not as expensive as we were in 1999. So not calling this a bubble by any stretch, but we also don't have an alternative to look at bonds as a way to say, well, we can still get 5 or 6% there, even just taking that type of risk instead of taking stock market risk. And so what that tells us is that maybe just says that we can justify some of these stock valuations that we see today because of how expensive, so to speak, that bonds are as well. And so that's where we want to make sure that we're being thoughtful about these allocations, having really good discussions with the investment committee about what is the right mix of those assets. And that, again, is an ongoing discussion every quarter to say, do we have the right allocation in place? Do we have the right underlying managers to make sure that that is something that you as fund holders don't have to be thinking about? And this investment committee, I have to say, is one of the most seasoned and investment savvy investment committees that we work with. They've spent a lot of time as a group cultivating the right professionals to be on this committee, the right volunteers, right, that work in these industries, that work in our business, to kind of understand really what we're talking about. And this is a really sophisticated group that's really made the right decisions, and brings a lot of intellectual firepower to the conversation. So just want to continue to give you all confidence that this investment committee at ACF is very, very much top notch. And I'd be remiss if I didn't mention some headwinds that could be out there, right? Again, we've talked about a lot of good news as we sit here today in 2021, but there are still some things out there that could create some volatility in markets, and not things that you probably don't know about, right? The Delta variant of COVID-19 spreading very quickly, and potentially creating some issues even for those that are vaccinated. And what does that mean for the fall here, getting back to school, kids that are not vaccinated, spread of that, and those types of things. Again, we don't know what that's going to hold, but that could be a source of potential movement for the markets here this fall. Political policy, obviously, there's an infrastructure bill that's currently sitting in Congress that could create some tailwinds, could create some headwinds, could create some excessive spending, or more spending that we've seen in quite a while on the government side. And what is that ramification for markets? Again, markets love or try to find certainty, right? They hate uncertainty, as I mentioned before. So what does that mean for policy on tax reform side? Something we still haven't seen a proposal on, but has been talked about by this administration as a priority as well. And then lastly, that something that maybe could be a little bit too technical for this discussion, but bond market tapering. The Federal Reserve has really spent a lot of time creating liquidity in the bond market, which has helped kind of boost returns here on the equity side and the stock side. But that program of buying securities to kind of create liquidity may start to come to a slowing and ultimately to an end starting here in the fall. And while they've been very forthcoming about what they intend to do, any change to the norm for markets could create some level of volatility. So again, it's been a really great year so far in 2021 for financial markets, and we want to make sure that we're being thoughtful, though, about what could happen here in the last 6 months of the year, to make sure that we're not panicking, we're not seeing anything unexpected. There always will be the unknown unknowns that are out there. But again, I think we've seen a really robust set of discussions here by the investment committee at ACF in conjunction with our meetings. And I think we are in really good shape to handle anything that's thrown at us here in the last few months of the year and beyond. So thank you for listening in to this, what tends to be a very long-winded discussion here. And we really appreciate it. If you have any questions, please feel free to reach out to anyone at the staff at ACF, and they'd be happy to get in contact with us if we can provide any further guidance. And again, thanks for listening in today.